Hello everyone and welcome to Investing by the Books, a podcast by Redeye. I'm your host, Eddie Palmgren, and today I'm actually alone here in the studio as my friend and colleague Niklas Sävås, who is usually here. He had to rush to the hospital and now he has become a father for the second time. I'm very happy for him, of course, and I'm excited to say hello to his new family member in a few weeks. In today's episode of Investing by the Books, I have the great pleasure of speaking with Adam Mead. Some of you listeners might remember him from our episode 21, the Omaha special that we did in the US, when we did a short interview after the Berkshire meeting. And for those of you who are not familiar with Adam, he is an American investor and the author of The Complete Financial History of Berkshire Hathaway. The book, which I have here in my hand, is heavy, almost 800 pages, and it tells in detail the story of one of the greatest companies and capital allocators in history. The Complete Financial History of Berkshire Hathaway was first published in 2021, and we are grateful to have its author on the show today. Here comes our conversation with Adam Mead. So hello, Adam, and welcome to Investing by the Books podcast.
It's great to be here. Thanks for having me on.
And where are you today?
Today, I am at home in Derry, New Hampshire, which is about roughly an hour, maybe 40 minutes north of Boston.
Is that where you usually operate from?
It is. This is home base.
And last time we met was in Omaha. And now to begin, how did your passion for investing start?
So investing, I guess I'll kind of rephrase the question slightly to start by saying I've always been around business. So I come from a family of small business owners. My grandfather had a tree service business. My father had a trucking company and a real estate development company. I sold firewood through high school. I got into motocross during my early days through college. And through that, I started a welding business. So I repaired exhaust pipes for these expensive titanium exhausts on dirt bikes. And so it was only natural that I would find investing. And so I just started reading probably everything that I could on business. And, one way or another, you're going to find yourself to Warren Buffett and Berkshire Hathaway if you're even remotely interested in investing or business.
And how early did you find them?
Yeah, I'd say probably pretty late, I guess. Certainly compared to Buffett. Buffett likes to brag. He was buying his first stock at 11. I was around business at 11, but certainly was not buying stocks at 11. I'd say probably around the age of maybe 17, 18. Because when I turned 18, which is the minimum age to open a brokerage account here in the US anyways, I ran out and opened a brokerage account. So I think probably 16, 17, I started learning about Buffett. And it was like, wait a minute, these guys... What do you mean you don't have to get up and go to work every day? Your money can make money for you. Like I just remember thinking like, wow, this is incredible. So I think the first Buffett book, I'm pretty sure the first encounter with Buffett was Robert Hagstrom's The Warren Buffett Way. And I've probably read or listened to that book a dozen times over the last, 20 years or so. It's just an incredible book. Of course, read his other books as well. But that one, I think it's just so fundamental. It's so good. It's just so timeless and such a great introduction to Berkshire Hathaway. So I would highly recommend that book. Even if you've read it before, go back and reread it.
Yeah, your friend Andrew Wagner that we also had on the podcast, he told us that was the book that really clicked for him, the first one for him, and that he has also been going back to. And you have also written your own book on Berkshire, The Complete Financial History of Berkshire Hathaway. And this amounts to almost 800 pages. And when we spoke in Omaha, you said that you really lived with the book for 5 years. So what led you to write it?
Yeah, so I even before I wrote the book, had, of course, like everybody, sort of obsessed with Buffett and Munger and Berkshire Hathaway, devoured everything that I could on the company, read all the annual reports and letters and all of that. And I just sort of pined for something more. Even Snowball, which was a very good book by Alice Schroeder, I just kind of always wanted a chronological history of Berkshire. And I would I would read Buffett's letters, and he would say things like, the MSR businesses, the manufacturing, service, and retailing businesses earned, 16, 17% on tangible capital. And I'd say, okay, like that's great, but I want to go into the footnotes, find out where that number came from. So it really was the book that I never found and always wanted. And if I was a rational writer, I just started writing this. I didn't pitch it to anyone. I just said, this book needs to be written. And one thing led to another. And Chris Bloomstrand, who wrote the foreword to the book, went out and actually found that there's over 200 titles on Buffett and Munger and Berkshire. So you'd be kind of crazy to pick that as a topic, but I did, and it's been wonderful. Just took me 5 years to actually write it. When I started the process, started kind of kicking around all the way through publication in 2021. So it's unfortunately now the incomplete financial history of Berkshire Hathaway because a couple of years have gone by, but maybe we'll see an update in a couple of years.
And was there some time during this period when you wrote it that you were thinking like, is it really worth it? Should I give up? Anything like that?
Yeah, I mean, it's certainly, I think every author goes through that process. And I think it took me probably about a year and a half. So it was only at the very end that I connected with Harriman House, and they have been a phenomenal partner with the book. So I had hired my own editor. I was going to self-publish this because I wanted it to be my own thing. And it took a year and a half for the editing process. And it was literally, 3 steps forward, 2 steps back. I mean, it was just this continual, and I'm, here's just a little secret, I guess, of my life. I was a C, D student in English class. I was never grew up thinking I would ever write a book. I didn't consider myself a good writer. So I learned a lot during the editing process, but that, there were times where it's like, okay, I remember thinking, I think it was around the mid 80s, because the book goes chronologically, decade by decade and year by year. I think I was in the mid 80s somewhere, and I said, oh my gosh, I've done all of this and I still have 35 years to go to write. What am I doing? But I'm glad I did. And it's an incredible, I have 2 kids, but this is really sort of my third baby.
Yeah, when you did so much work on it, I guess it's some sunk cost that keeps you going and you don't want to stop and give it all up.
Yeah. And even, this is another interesting thing that I didn't expect was in writing the book, again, chronologically year by year, but, call it 3 years or so of just writing, researching, all of that. And so I hadn't really gone back and read my earlier work until the editing process. And when I got to that process and read the whole book cover to cover, basically looking for typos and looking for, sort of at the tail end of the editing process, I actually connected some ideas and said, wow, this is interesting, just reading the whole thing in one go. So I certainly encourage anyone to go through and take the journey I took, which was basically 10,000 pages of research material and a couple hundred hours of video and annual meetings and all of that. It's well worth the journey, but I hope that I've captured all of that. 800 pages sounds like a lot, but in that context, hopefully it's enough to tell a pretty good story of Berkshire Hathaway and be a companion to some of the other great books that are out there on the company.
I definitely would say so. And as you say, there are about 200 books on Berkshire that we can find. But what do you think is the most surprising thing that you have found that you didn't find in those other materials?
Yeah, I guess, Buffett encouraged me. I was originally going to start the book 10 years before he took over. So my chapters are laid out in decade increments. And so Buffett came in 1965. I said, I'll go back to 1955 and go to 65 to 74. And I sent him the first 2 chapters, which was 55 to 1974. And he wrote back, that was my first sort of communication with him on the book. And he said, well, geez, it wouldn't be interesting if you went back and looked at the World War II era and sort of this brief temporary profitability that the businesses um, benefited from. And of course, if Warren Buffett's suggesting something, I'm gonna go and do it. Um, so that led me to go all the way back to the 1800s. But I guess the really interesting thing about the earlier days, as the textile industry shrunk, we kind of think of Seabury Stanton, who was president of Berkshire Hathaway. Buffett had this infamous, now famous board meeting where he took control of the company, and we think of this guy Seabury Stanton as this sort of old curmudgeonly textile guy, which he was. It's mostly true, but the Berkshire Hathaway management that preceded Buffett was actually pretty rational. They shrunk the business as the industry had shifted to the South and then overseas. They shrunk the business and returned $22 million in capital to shareholders. And that sounds small today, but that was about 40% of Berkshire's beginning shareholders' equity in 1955. So the management pre-Buffett was acting pretty rationally, and that's actually what caused Buffett to be interested in Berkshire, because he thought that he would get bought out. And as we now know, and as the story goes, Seabury Stanton stiffed Buffett for an eighth of a dollar, and the rest is history. So that was an interesting one pre-Buffett. Another interesting thing I found, again, comparing Berkshire's entire history, was we know Buffett likes concentrated bets, value investing, focus investing, concentrated investing. What was really interesting was to see the largest single stock investment in each decade was no less than about a quarter, I think at 23% of Berkshire's equity at the time. And the largest by percentage of equity was actually the Illinois National Bank that Berkshire bought in 1969. It was forced to divest of the bank in 1980 because of bank holding regulations. But that was 44% of Berkshire's equity capital at the time of the acquisition. So it was this massive, massive bet. National Indemnity, which formed the basis of Berkshire's insurance empire today, was 28% of Berkshire's equity capital in 1967. So even that was smaller. But what we've seen over time, and I have a table in the 50-year wrap up in the year 2014 in the book, just showing each decade the largest both stock market investment and wholly owned subsidiary acquisition. And what we've seen over time is this penchant for concentration has not diminished. And we see that today with the Apple holding at 40% of the equity portfolio and still 30% of Berkshire shareholders' equity. So this hasn't gone away, and it also leads to the next thought, which is, okay, what's next? If Apple, it takes an Apple to get that big, what is the next big thing? And it really just shows what Berkshire is up against. But Buffett has managed both sides of the balance sheet very well. We know float is low cost capital, but he really thinks of both sides of the balance sheet independently and has managed them separately. And one thing I found interesting was in the late 1980s, he borrowed $250 million at 10%, and then turned around and invested it in treasuries at about 6.5%. And he even says in his letter, we're losing about $150,000 a week on this. But he thought it was a good time to take advantage of raising capital. So they would raise money in advance of a need. And this is different from pretty much the way the rest of corporate America works, which is we have an acquisition, we have an idea, okay, let's go get financing. But as Buffett says, the ideal time to make an acquisition and the ideal time to borrow that money is not necessarily at the same time. And so you see this splitting of the balance sheet and managing it separately, which again, I hadn't really seen anywhere else. And then just lastly, float, everybody says, it's been talked about a lot, but how Buffett has used the permanence of float by focusing on underwriting profitability And not only just sort of that basic business, but how by being very patient, he would essentially in um, loose years when pricing was poor, other insurers were tempted to go out and grab business. Berkshire would just wait and essentially capture that business on the back end by doing reinsurance transactions 3, 4, 5 years down the road. So they would let the other primary insurers take those risks, make that bet, and then turn around and basically take that same business with a reinsurance transaction at better pricing. And it's just so obvious. And you look at this and it's just so incredible just how simple it was. But I haven't really heard really anybody talk about that. So that was another one.
Interesting points. And the last one there, is that something that, as a private investor, that we can use in some way, that kind of thinking to wait and then find another way to make your money?
Yeah, I think, again, patience is always great to practice. I've found in my own investing career, each cycle, I get a little bit more patient. Stocks went down by 10%. Let's go in and buy. And then as I've gotten older and matured, it's let's really wait for these good deals. And um, if you're feeling like you need to do something, pick up the high low list of any stock or an index and just compare the high and the low in a 12-month period. And it's incredible how much even mature, stable companies fluctuate in share price over time. And so it's just another way of, okay, let's stay rational. Let's wait for others to make mistakes. And the idea of having a watch list and having multiple companies that you would be okay buying, not getting stuck on one. I have to buy, XYZ company today or this week or add it to this year. Having a list of companies that you can just wait, study, let them go on sale, really is kind of the Berkshire playbook.
And we'll get into your role as an investor a bit later. But if we stay on the track of Berkshire Hathaway, and as you talked about, the textile industry was where it began, and Berkshire is so much more than textile industry. But one of the lessons for me is at least this difference between growth capital expenditures and maintenance capital expenditures. And can you tell us a bit about that in the textile industry and what you learned about that?
Sure. So basically, as the textile industry changed and evolved over time, really what was happening was returns on capital were going down, and yet there were instances or opportunities to invest capital that would improve output. And I think it was Charlie Munger talking about this, where he says, Buffett would look at this and say, geez, they've invented some new machine and it's going to improve productivity. If this happens, I'm going to close down the textile industry. And it's like, wait a minute. But he was asking the question and alluding to this notion of, and then what? So Buffett's quote is, everybody's at the parade and everybody wants to see better. So you get up on your tippy toes and nobody sees better, but everybody's legs hurt. And that was the textile industry, where they would make these investments and new technologies would come, but yet over time they would earn terrible returns on capital because there was nothing protecting that investment. All of the productivity flowed through to the customer. Nothing really, as Munger says, stuck to the ribs of owners.
And do you see this happening in other industries today?
Yeah, there's nothing that comes specifically to mind, although it was interesting. We got a little bit of a case study on when the U.S. tax rate went from 35 to 21%. It wasn't immediately obvious whether that change was going to, again, get passed through to customers or remain as profits for business owners. We saw with Berkshire's businesses, a lot of them got to keep that bottom line, basically. Um, I think perhaps the trucking industry, truckload trucking, sort of the basic commodity type business suffers a little bit from this. But I think sometimes it can be hard to tell, but I think it's key to really just focus on sort of the bottom line of what we're trying to do as investors, is get a return on our capital. So what if you're seeing returns on capital decline over time and you're seeing these trends, um, probably better just to find a different horse, just kind of bail on the industry. It's not something that happens overnight, I think. I tend to shy away from technology companies and fintech and things like that. But I would imagine that or it seems that happens a lot where it's almost this delusion like, okay, we need to spend this money on marketing and we're making these investments in intangible assets and somehow they never materialize. And I suspect that there's a little bit of that happening. Although, like I said, I'm not really an expert and I couldn't tell you. I'm sorry, I don't have a specific example that kind of comes to mind.
Yeah, it's an interesting thought because the textile industry was so capital intense and it's a commodity business, while these tech companies, they are capital light in one way. I mean, they don't have tangible assets in the same way, but they also, as you say, they invest heavily in people. And of course, they want to have brands and build and scale that business. But sometimes you don't see anything on the bottom line and you have to wait a long time before you can see anything. So maybe it's too early to say. Another thing that I was thinking about is consolidation, which was also something that the textile industry was facing. And it was because there was more and more challenges, of course, and it turned into more conglomerates, which didn't help to make it profitable. And another suffering industry that I come to think of is airlines, which Buffett has pointed out is this fiercely competitive, and it's costing him and other investors so much money. And when I listened to the shareholder meetings from 2017, then Buffett was still defending that Berkshire was investing in these 4 major US airlines. And he saw it more of an industry play. And he was comparing this to the railroad industry, which was also terrible for a long, long time until it got consolidated enough to make the remaining players profitable. So what do you think is required for industry consolidation to become a long-term competitive advantage?
Yeah, it's a really great question, and I'll do my best to answer it. I'm not sure I have the secret sauce here. um, Buffett's quote about a good manager ending up with a poor reputation because they've attached themselves to a poor business, I think applies here. You know, more or bigger doesn't always equal better or more profitable, as we saw in the textile industry. I think what's required to make consolidation useful, from a shareholder's perspective, is for something to change fundamentally. And so with airlines, and I'm again by no means expert on the industry, I took Buffett's advice and I just kind of stayed away. Um, but from what I understand, consolidation allowed greater average utilization of planes. And so it rationalized these routes, eliminated some of the worst of this cutthroat competition that kept utilization down. And, of course, it costs the same to fly a plane from A to B, whether it's full or half full. And so I think that is what happened there. The question really is, pandemic aside, what would change that? What would alter that? What would cause new entrants to come back in? I don't know. Railroads, it was a combination of relaxing price regulation, productivity investments that allowed more volume with less labor. They double stacked the trains. They um, increased the bridges or the heights of the tunnels. They reinforced the bridges that allowed a lot less, um, more to be done with less. And there, I think that's more permanent, especially from the competitive standpoint, um, because you can't just go build a new railroad today and the rights of way and all of this. Now there's recently the STB, the Surface Transportation Board, has come out with this idea of, well, geez, the railroads should share their tracks, and that will lower costs for everyone. I don't know there's always that risk that regulation will harm the industry, but I think from a fundamental standpoint, that one's protected. So something critical has to change there. And one thing that isn't totally predictable is how the industry participants will act. Will they stay rational and not try to undercut each other? Will they sort of just allow good profitability to be the norm of the industry, or will they sort of get irrational and say, no, we need to have market share and we're going to compete on price? And I don't know if there's a perfect way to predict that. I will say from my perspective, from a value investor's point of view, you don't have to be right day one. I think you can allow these things to sort of happen and watch these strategic shifts and watch. I mean, that's really what you're trying to do. Once you figure out the business, the industry, and what's happening, really sort of that work that you do next is the strategic type of analysis. And you're really trying to put yourselves in the shoes of an owner and even a board member and just think, okay, what is strategically happening in the industry? What should we do to react or change? And that generally takes time to materialize.
And coming back to Berkshire Hathaway, it's really clear how the 1960s and the 1990s, this point of these decades, they were really formative in terms of the growth rate in sales and earnings. And we have seen decreasing returns as Berkshire has grown. And that is, of course, something that Buffett has been clear on for a long time will happen with size. But can you tell us about the main sources of growth during these formative years and decades?
Yeah, there was, I think the first thing that really jumps out is, well, certainly Buffett's capital allocation skills. He came into Berkshire Hathaway with, okay, now that I'm in this business, it's not a cigar butt. I'm not going to be able to sell it back to management. I'm going to actually manage this thing. He quickly reallocated that capital to better businesses. And the Illinois National Bank was one. Probably the biggest source of growth was National Indemnity, this platform of insurance, which brought with it the ability to have a huge marketable securities portfolio. So he really, really got the best of both worlds. And, part of Berkshire's success, and I think they've even talked about it, is luck. Buffett and Munger had the advantage of coming after sort of these crazy conglomerates of the 1960s and all the accounting craziness that they did, and just kind of accounting fluff versus actual economics. They came after that, but before this incredible boom that was, the U.S. economy, and things were still inefficient. So Berkshire really got its start in the sweet spot, and that's a part of it, I think. And I don't think Buffett would deny that.
And M&A has, of course, been a huge influence during these years. And Munger has said that Berkshire has made many good acquisitions, but that only a few really moved the needle. So which do you think he refers to?
Yeah, that's a good question. Berkshire has always been sort of this mix of stocks and wholly owned businesses. And again, we saw that right off the bat when Buffett took over and started reallocating some of the capital from the the textile business. In the early days, and I'm just kind of using the 70s as sort of a good launching off point. Stocks were about 100% of Berkshire's equity capital at the time. That rose to about over 125% in the late 90s, and then kind of declined over time. And so when you kind of think about that, Buffett was able to generate a great return on that capital, and it was equal to Berkshire's equity capital. So if they're earning 15% on the stock portfolio, that translates 1-to-1 to return on equity for Berkshire shareholders. And then on top of that, you have all these operating businesses. So National Indemnity, I think, would probably rank right up there at the top, just from the standpoint of being an insurance platform, giving Buffett this float to invest. And I think probably more important or equally important is the lesson on how to run an insurance business profitably. That really, really solidified the way Buffett approached insurance. And they created a whole host of insurance companies, all these home state companies in the 1970s. And some of them failed, some of them wound up or combined with others. They ran into some profitability issues. It was not easy. So even with sort of, okay, here's the playbook, it was really hard to do. But focusing on profitability first was that key lesson. Geico, they bought the first half of that business for $46 million over time. The second half they bought in 1996 for $2.3 billion. So there again, just sort of supercharging Berkshire's results, float, and profitability, really the best of both worlds. Seas, which they bought in 1972, just a fantastic business in its own right. And then there, again, was the key lesson that good businesses were sort of the new playbook. We're going to get out of this cigar butt by poor businesses for cheap and resell them and get into holding good businesses over time. And again, everything sort of interrelates here. Coca-Cola came from that, the late 80s. Washington Post was a $10 million investment that turned into a 100x, turned into over $1 billion over time. Scott Fetzer, 1986. I think a lot of people don't quite appreciate Scott Fetzer. It's one of my favorite Berkshire acquisitions.
Why is that?
Yeah, so Scott Fetzer is a mini conglomerate. So its main two businesses were Kirby vacuum cleaners and World Book encyclopedias. Each of those businesses was roughly 40% of profits in the early days, and then there were all these other, about 18 other businesses that made up that 20% remainder. But that acquisition doubled Berkshire's revenue base by adding about $700 million of revenue. They paid a little over $400 million for that business, but they dividended about $125 million out right away. So their net purchase price of about $285 million, which at the time, again, 20% of Berkshire's equity capital, generated billions of dollars of capital for Berkshire. And what's really interesting is, so Buffett says that the CEO, Ralph Shea, belongs and is in the Berkshire Hall of Fame. That business, Scott Fetzer, literally faded to a footnote in, I think, the 2004 annual report. Literally faded to a footnote. It wasn't a huge growth business, but what Ralph Shea did was increased basically capital turnover, was able to get more profits out of the business and return capital to Omaha for reinvestment into other things. Just an incredible business. Kirby was just sold off last year. World Book has struggled. And some of the other businesses are kind of plugging along, and they're pretty good businesses. But growth, the big lesson there is growth doesn't have to be necessarily a part of the equation. It can really be that nice capital generator. And then probably Berkshire Hathaway Energy as sort of this platform. Again, Buffett has called it staying rich versus getting rich. The energy business is sort of deceptively simple. It's a very good business. They earn basically regulated returns of 10, 11, 12% in certain cases, and can take all of the capital that's generated and more. They've never paid a dividend since Berkshire bought it in 2000. And another one of those sort of key businesses in the Berkshire history.
It's fascinating with that whole scale-up phase, and we see many companies that are going through it and trying to find their way. And you mentioned the funding as one part that was surprising to you, how Buffett acted and borrowed up money already before they had an acquisition, and they even paid a lot of interest for it. Are there any other lessons from funding in this scale-up and startup phase that you have learned from Berkshire?
Yeah, but borrowing in advance was certainly big. The use of float. I think a lot of people sort of still amazingly don't fully appreciate the Berkshire Hathaway and what it is. Um, all of the puzzle pieces really are designed to fit together. And so the insurance operations provide float for use in the investment portfolio, and that allows they can use that float to buy whole businesses. And because they operate the insurance business very conservatively and they don't write as much premium volume as they actually could, that allows them to do things more aggressively in other ways. The operating businesses provide stability. I mean, literally the entire railroad, BNSF, is owned by National Indemnity, just churning out $5-6 billion a year, which makes the insurance business more stable. And so this has just been sort of the playbook over the years of just have each piece of Berkshire operate independently and maximize its value. But the whole really is worth more than the sum of the parts. I see people say, well, geez, wouldn't it be great? Buffett dies, whatever. They spin out the energy business or they spin out the insurance business and it's going to be valued at this. And it's just it's a mistake to think that. And it's just so surprising that it's still misunderstood today.
Yeah, I really like that part where you describe it in the book, why it should not be broken up into pieces. Can you elaborate a bit more on that?
Yeah, again, the things that I mentioned, and really it comes down to when you're buying a stock, when you're buying a business, its value is the sum of the cash that it's going to generate over time. And if you just break it down and use pretty simple logic, is breaking up Berkshire Hathaway going to increase those cash flows over the life of the remaining life of these businesses? My answer is no. I mean, there may be certain instances where a subsidiary that's spun off has, people asking questions about it, and they feel more pressure to operate more efficiently. But in my when I walk around the Berkshire Hathaway meeting this past year, I talked to a bunch of the managers, and they told me what it was like. One of my main questions was, what is it like to work for Greg Abel, not reporting directly to Buffett? And every single one of them said, Greg asks these great questions, and Greg is not just sitting there, sort of doing his thing. He is actively involved in improving and these businesses and looking at them. And I think doing it in a way that's Buffett-like, which is not, geez, why are you doing this and not this? It's, well, geez, your competitor is doing this. What have you guys done over here? And I think there's so much good inside Berkshire, and there's the reputational aspect of having people that have built their businesses come to Berkshire to put them in this museum and know that they're not going to be sold. That is worth much more than any spin-off at some crazy multiple would be over time. I think the reputation is worth far more to Berkshire.
And you also mention all the costs and the time to talk to investors and have different IR services and so on.
Yeah, again, as Berkshire has bought, I don't know this number, but dozens of public companies and turned them private, and they don't have to have long board meetings. They don't have to do all these preparations for quarterly conference calls or meet with investors. I was looking at a pretty mature, established, very good business just recently, and I'm always just so shocked to see on the investor relations page how many times they do these conferences. They go to these conferences. They're presenting at this conference and they're presenting at the JP Morgan Investor Day thing, or it's just all of that is so much time that could be spent building the business and protecting the business. And that's something that these managers don't have to do within Berkshire Hathaway.
And when you say all the reasons for why Berkshire has become what it is, it sounds almost simple. very logic, the playbook. But of course, Berkshire and Buffett and Munger, they have also faced a lot of challenges. And one factor that had a big impact on the general business environment during this scale-up phase was inflation, which was very high during 1970s and peaked at 12.4% in 1980, as you write in the book. What are your lessons from how Buffett and Berkshire dealt with this high inflation?
Yeah, so I think there's two things come to mind. One is sort of the more general coping, if you will, and the other is insurance, which was and is Berkshire's main economic engine. So during that inflationary period, it was really two types of inflation. They faced the general price inflation uh, that made repairing vehicles, repairing buildings, repairing humans, as medical advances got better and more expensive, that caused additional cost inflation for insurance companies. And then there was this other element of social or judicial inflation, where a company agreed with the insurance company to insure the deal for this, and that was what in the contract. And then it went to a jury trial, and the jury said, "Nope, we're going to award, way more in compensation to this individual." Um, the way they dealt with that was sometimes shortening their renewal periods from a year to 6 months, increasing pricing where they could. There were a number of years where they just could not keep up, and part of that was because of regulation, part of it was because of competition. So that was the insurance side. And then on the other side is just businesses. So insurance just destroys the profits that businesses generate and really skews the economics for owners. When you are paying a tax on inflated earnings, you have to pay Uncle Sam, and then you have to turn around and reinvest in that business just to sort of maintain your spot and maintain your your productive capacity. You really get nothing as an owner. And so the time to think about inflation is yesterday. It's just always. And I think Berkshire has done a great job of that over time. You should not be thinking about inflation today or, 3 months ago or 6 months ago when it sort of first started coming back up. As a long-term value investor that holds businesses, holds stocks for the long pull, you really should be buying businesses expecting that inflation is going to happen, because there's just this bias in every government, every monetary system over history to inflate or devalue the currency. And so I think, again, See's Candy, that was a perfect example of a business that could combat inflation. Coca-Cola. I mean, you just look at Berkshire's portfolio. It's chock full of these businesses that will do just fine in inflation.
And moving over to your role as a practicing capital allocator, you are the CEO and Chief Investment Officer of Mead Capital Management. So can you tell us a bit more about your business and what you do?
Sure. So everything I do today, I spent 10 years in commercial credit. So that was sort of my continuation as an investor, lending to businesses. And then 2014, I actually started Mead Capital. I went full-time at that in 2020. So I have a couple pieces of what I do today. And again, everything is kind of part of the whole. Mead Capital Management is where I have a fiduciary duty to manage money for my clients, who I basically run. I run separate accounts, so every account is mirrored, so it kind of looks like a hedge fund, but every client has their own account. I have a value investing newsletter called Watchlist Investing, and that's really my research process. It's a paid subscription. There's also a free Substack, but it's where I put ideas out there to an audience, some of which pay me to deliver them value. So I'm getting that feedback. That's really my research process. And then as a compilation or as a companion to the book, I have a website called The Oracle's Classroom, which is sort of this compilation of timeless investing wisdom that's centered on Berkshire Hathaway. I also have a YouTube channel as well, where I take clips of the annual meeting and kind of distill all these timeless lessons. So that's kind of the three legs of the stool. I call myself a practicing capital allocator, actually manage money for clients, the research, and incorporating that timeless wisdom. It all is kind of part of a piece.
And do you have any habits on a daily basis that helps you to navigate?
Yeah, I always come back and I sometimes will write down on a little sticky note, focus. And it's really hard with everything that's going on to stay focused. And you have kids at home and you have all this. My habits are trying to understand myself and when I do things best. So I generally try to turn my phone off and just focus in the mornings where I have the most energy. I can do research. And then it varies week to week, but I think that's probably the biggest one. And then just, one area where I disagree with Buffett, I think he's come around to this over time, but he's basically said, a calorie is a calorie, and he's famous for eating ice cream for breakfast and chowing down on 5 pounds of See's candy during an annual meeting. I eat my broccoli. I think it's important to take care of your body, take care of your mind, get good sleep. The way you treat yourself today is going to impact how you function tomorrow. And so I try to just keep this chain going, where I treat myself well and just understand sort of the ebbs and flows. And everybody has a bad day, but again, just kind of there's so much that I do that no matter sort of how I'm feeling, there's always something to do that's productive. It's kind of what I've found.
We also focus a lot on health here in the office and in our private lives. But is there something else you do differently from Buffett?
Probably, I think, again, another thing there is I thank Guy Spear for this insight. You don't have to be Warren Buffett, and you have this bar that's set so high where, okay, I need to read, 10 hours a day and, understand all these businesses. And I've decided a long time ago not to, I think Buffett sort of neglected his family in the early days. And that's something I'm not willing to do. If I'm a slightly worse investor because I do that, I'm willing to make that trade. I think, I can be a pretty good investor and still be able to get the kids off the bus and do different things. And that's probably another area where I differ from Buffett.
And speaking about setting a high bar, I guess from studying Berkshire, you really have a high bar for your investments. But how do you tackle the situation of seeking perfection, but also settle for less?
Yeah, I guess, what do you mean by settling for less there?
It's hard to find the perfect investment. There's always some flaw, something you have to live with, at least in my experience.
Yeah, no, okay. Yeah, that makes sense. I guess my philosophy is to own better businesses, and again, generally, when you look at Berkshire's investment in Apple, you didn't have to get in on the ground floor. It had such a long and exponential curve that you could be late. You could take your time, study the business, see where it was going, see the economics, see the moat, still get on that train and do well over time. So I use that example a lot, and I just remind myself that you don't have to have 25 perfect investments over a lifetime. Really, the key is to avoid mistakes, and by focusing on studying businesses over time, I sort of liken what I do to, there's sort of two camps. One is the people where a market or a company gets into trouble, stock price goes down, they rush in, they try to analyze it, they try to figure out what's going on, they try to figure out the value, and they try to buy it at a good price. I don't think I can do that. I liken that to your neighbor's house is on fire. They come over to your house and they say, Adam, you can buy my house for X. And I have to think, okay, is the fire department right around the road? Are they tied up? What else is there? 10 gallons of gasoline inside the house, the thing's going to blow up. You're just, there's so many questions, and it's so hard to be good at that, at least in my, for me. I'd rather take my time to get to understand a company and to continue this house analogy, which may be a poor one. You study your neighbor's house, you go down to the town to pull the building permits and see that it's made out of, block, and they have firewalls, and the fire department's right around the corner, and there's a fire hydrant right out front. Now you can act rationally. Now you've done your homework up front. And so I think the combination of focusing on good businesses, taking your time to understand them, and just continually try to question yourself. And if new information comes up, just put that into the sort of revaluation process, has generally led to better results for me over time. Now, I've made a lot of mistakes over the years. I actually have a file I called the Folly Gallery that I put all my mistakes in. So I take Munger's advice to rub my nose in my own mistakes. It's hard, but it's rewarding too in different senses.
I like the house analogy that you provide there. But do you actually do that? Do you go to the house and look at it and go inside and do all that field work? Or because Buffett has been criticized for being this desk investor. He's sitting in his Omaha office and reading, and he's not so much out in the real world. Are you doing that, the real scuttlebutt work, so to say, or the sleuthing to find this physical evidence?
Yeah, a little bit. Not to the extent of, there's always that risk. You go out to meet management and you communicate with them. You're getting a biased view. I guess it's just more of a sense of always being curious. So anybody you talk to, even if they're not an investor, maybe they work for a company or they're a supplier to a business. I think there's just so many ways to get at that scuttlebutt. Today, I think we have such a leg up in terms of access to certain things. So I just subscribe to In Practice, where they do interviews with people in businesses. I think that's an incredible service, and really just understanding, just following the business over time. I find it so much more enjoyable to follow a business over time, even if I don't own the company. It's just really interesting to just focus on a few. I mean, that's watch list investing. That's what I do. Just build a list and just follow them, and you learn all these little nuances over time that you wouldn't pick up, or you by keeping it in the forefront of your brain. You're sort of always thinking about it, and going out to the Berkshire meeting every year. I had a conversation with Tom Russo this year about the beer industry, and just a couple of comments that he made. A couple things clicked in my mind, and you don't get that if you're just going from A to Z to B to M. I mean, you're just all over the place. I think really just focusing on a few industries, and even, this is sort of getting into a tangent here, but focusing on things that you're interested in, I think also helps, because if you're not innately curious about it, you're not going to do a good job as an investor. So you don't have to understand every industry. You can really just go to what interests you, and that curiosity, I think, helps you over time, and your knowledge compounds over time.
And what type of businesses usually interest you? Is it the copycats of Berkshire? Are there any such companies? We know Markel and a few others. Is it that type of businesses, or what are you looking at?
So again, surprisingly, I have not. I don't consider myself. Markel is probably the closest mini Berkshire. There's Allegheny, there's Fairfax. I don't. I haven't. I'm not an expert on those businesses. I really have just focused on Berkshire Hathaway. I think my circle of competence certainly includes banks, but I'm very particular about what I want in a bank, because I've spent time inside of a bank and I know how they operate. And I know how things can kind of get hidden, or just problems can kind of get buried below the surface. I like businesses where I can understand sort of the unit economics, how many units flowing through, whether it's a Fastenal, through a certain number of stores, looking at Boston Beer Company or Heineken or Anheuser-Busch InBev, how much volume they're putting through, how many barrels of beer they're producing. Those businesses where I can really understand and see the economics working over time, I think I can do a pretty good job at. There's so many that I don't quite understand. I spent some time, again, I spent 10 years in banking, and I learned how hard it is to replace a bank core. It's almost literally like getting open heart surgery. Everything is connected to a bank core. So I looked at Jack Henry as one of my deep dives for watch list investing, and they have their sort of legacy core bank software, and then they have this other business in payments. And I feel like that's straddling the edge of my circle of competence. I only understand basically half of that business. I really understand how the bank core is very sticky. I don't know where they're going to go on the payments side. So it's very subtle. And I've actually found, as I've gotten more mature and I think a better investor, my circle of competence has actually shrunk over time. And I think that's okay. I think that's a good thing.
Yeah, I guess if you say it like that, then it sounds like your circle of competence wasn't really that big that you thought it was before.
Yeah, it wasn't as well defined as it should have been.
Yeah, that's a good way to put it. But are there any other common cognitive biases that you have realized in your files of mistakes?
Yeah, I think I'm an analyst at heart. I like the detail. I like the spreadsheets. Sometimes going down those rabbit holes, I can get lost in some of the numbers. And you had my friend Andrew Wagner on your show recently. Wonderful interview, by the way. Andrew has degrees in economics. He's not a macro investor, but he sticks to sort of the bigger picture over time, and I can kind of get down into the weeds. And so having Andrew as a friend really helps me with that. But I am definitely one that can go too deep at the expense of the bigger picture, and it's something that I've had to kind of learn over time. The other one, just sort of by virtue of what I do, certainly with watchlist investing, publishing my research, some of which are companies that I own, there's that consistency and commitment bias where I really have to guard against, okay, I'm saying that I think this thing is a good company and I think it's worth X. I shouldn't maintain that view if something changes. I haven't really run into this. I think I've picked pretty good companies over time. But even subtle things like, should I reevaluate this, or this new piece of information came to light? Well, no, I wrote about that. It's still a good business. I don't have to worry about that. I think what was it? Darwin's advice to write down the thing that you're disconfirming evidence. I think it's something I should probably do more of to combat that.
And the first point you mentioned is interesting, by going into the details, and your book is really an example of that. You go into the financial details of Berkshire Hathaway for all its lifetime, and you even go back to the beginning of the textile industry. And at Redeye, we have this quality rating where we evaluate every company and we follow them based on these three main categories. So it's people, business, and financials. And as I said, your book really includes many important aspects of the business, but as the title suggests, it's also this financial aspect of Berkshire that is in the limelight. So while going through all this material, was there something you learned about accounting? Because it's a big part of it.
Yeah, accounting, as Buffett says, is the language of business, and you really need to know it. And I think by studying, Buffett just does such a good job of explaining accounting over time and the accounting rules that change. And there was one instance, I forget which year, fairly recently, I think. Anyways, the year's not important, but he literally goes down and says debits and credits. Like, this is getting debited, this is getting credit. It just literally lays out the T account, which I just thought was incredible. But I think in looking at Berkshire's history over time, and even just the history of accounting over Berkshire's history, how much it's changed over time. So one example was early days, securities were valued at cost on the balance sheet versus market. And then oddly enough, that sort of started to change in I think the 1970s, where in only insurance companies, it was valued at market, and the rest of any other balance sheet, it was valued at cost. Just these like odd things. So it's kind of this quirkiness of accounting. Um, Another example is so Berkshire has done a couple of acquisitions over time where they've purchased a controlling interest and then they've gone back and they've bought more. So they did this with Shaw Industries, the carpet manufacturer, in 2004. Um, they bought Marmon in a couple different chunks, Iscar, IMC, a couple different chunks. They're now doing this with Pilot Flying J. In any event, when you buy a business for more than the equity that's on the books, you book goodwill. Okay, that's pretty simple, pretty straightforward. Well, these additional purchases, instead of booking additional goodwill, that excess of purchase price gets written off immediately. It's just like this odd accounting quirk. Again, Buffett does a good job explaining it, but it just sort of highlights you really have to use the accounting as your language, as your guide, but it doesn't do the thinking for you. And a last example I'll put out there is with reinsurance. So with retroactive reinsurance, the premium is generally less than the future expected loss because you have this time value of money where you're getting a premium up front, you're insuring this risk, and even though you expect to pay out more over time, you get use of this premium up front. With retroactive reinsurance, you put that excess loss on the books as a deferred charge and you amortize it into earnings. If you write an excess reinsurance contract, it's the same economics. You're getting that same upfront premium with future expected losses, except the loss is charged to expense immediately. So again, that's sort of a very specific to Berkshire Insurance, but it just highlights these little quirks over time that you sort of have to, one, pay attention to understand the economics, but two, understand how the accounting of it might have changed over time.
Yeah, and Berkshire is, of course, a special company with many divisions and many special businesses. But when you look at other businesses, it might also be an opportunity for you, I guess, if you really know the language and you can see things that the market or other investors are missing. Is that something that you benefit from, you think?
I think so. I'm sure of it. I would say that although accounting is a language and learning another language can be difficult, I forget how Buffett put it exactly, but he says if you don't understand it, it's not you, it's the management. You read Berkshire's. I would just encourage anyone to pick up. Don't be daunted by how thick it is or some of the language you see. Just pick up an annual report of Berkshire Hathaway, and you just read it. And there's so much clear language. It doesn't have to be complicated. It doesn't have to be complex. So I think for me, when I see complexity, when I see like, wait a minute, I don't understand this, or why is this number over here? It's a sort of a red flag to me to say, wait a minute, this is not me. I mean, read the Fastenal annual report. That's another good one. There's a couple of these companies out there where you read and it's just plain language. Just here's what we're doing. Here's why this is this. And it's management's job to do that communicating to the shareholder base. And it's okay if you have questions. And again, another little tip, just email or call investor relations and ask them a question. I've done that numerous times. You don't have to be a hedge fund manager or, licensed or what. Just email and say, hey, geez, I was wondering about this number. And 9 times out of 10, you're going to learn something about the company and probably about accounting too.
Good advice. And for the last part of the podcast, we always talk about books, and you took on one of the most demanding tasks when writing the complete financial history of Berkshire Hathaway. So we are curious to hear if you want to write another book and when we can expect a new edition of this one.
It's kind of like when you start to have kids and your parents, you get married and, well, geez, when are the kids coming? When's the next coming? Still exhausted from this one. No, I would say probably a second edition of the complete financial history of Berkshire Hathaway. I kind of in my mind think that it would be nice to round out. It's probably like in somewhere in 2025. So the way that the chapters go, the next one would end in 2024, which if Buffett's still around will be 60 years at the helm since 1965. So I'd say that's very likely that will happen. Possibly a book. I've kind of kicked it around with a couple different people of basically making the tome, the door stopper that is this first book, a little bit more accessible to sort of the everyday person, just kind of distilling the key lessons of Berkshire's history, those timeless lessons, maybe with some current examples, make it a little bit more accessible. I'm on the fence. It's like, do we really need another investing book out there? I haven't quite decided, but that's one I've been kind of thinking about.
And is there any book that not even you would want to write, but you would like to read it?
Yeah, that's a really good question. Munger has said if he taught a business class, he would take 100 case studies, I think of good businesses, but also maybe failed businesses. So maybe just call it both. 100 case studies of really good businesses and failed businesses, and go through those case studies. And what are those key lessons that you learned and so forth. So this idea was actually Jake Taylor's. I'll give him full credit for this. He had the idea of taking Buffett and Munger's predictions over time and seeing how they've panned out. Just little offhanded comments, like I wouldn't expect interest rates to stay low for so long, or this business should do this over time. Just little things like that you could go through and just kind of see what their predictive capacity is over time. I thought that was kind of an interesting one.
Yeah, and when we had Jake Taylor on in the podcast, it was episode 2, then he said that he would like to have a book on all the compensation programs and how Buffett and Munger has been thinking about compensation, but that it's almost impossible to gain that information. And that's, you asked the last question, I think, in 2018 on the AGM, and that was a similar one.
Yeah, that's another great one. I would love to get in there, and I tried to suss that out with that question. Yeah, it was the very last question of the day, and Munger kind of cut Buffett off. No, we don't want to reveal these secrets. But if you go back, and I've highlighted some of them on my YouTube channel, I've made a playlist where the question has actually been asked a couple times over the years, and I've gone through, like when I was writing the book. So because Berkshire Hathaway Energy has publicly issued debt, they file their own 10K. I was actually able to find the compensation agreement with Greg Abel and David Sokol at the time. And it kind of, what I've kind of sussed out from their comments over time, and even talking to some of the managers at the Berkshire meeting, is it's based on the economics of the business. And what sort of throws me for a loop, it's like, well, we made this, Buffett talking, we made this deal with, so-and-so, it was 2 paragraphs long and it's been good for 40 years. It's like, well, okay. So clearly it wasn't tied to some specific profit number, but I think it really is tied to the economics of the underlying business, how much capital they use, something that scales with the business. And then the compensation, if you look at the compensation structure of Todd Combs and Ted Weschler, the 2 investment managers, they're compensated 80% of what they do, 20% of the other guy, and they get 10% of their outperformance over the S&P over time. And I've noodled that over time and have said, geez, that's a brilliant way to structure it, because it scales over time. If they're managing $1 billion and they outperform the S&P by 10%, they're going to get 10% of that, or 1%, 1% of $1 billion. Or if they're managing $100 billion, but their margin shrinks, the absolute dollars grow because of that. And so it's completely scalable. So it just, so much of Berkshire Hathaway is just simplicity. And I think that's where a lot of people get tripped up, where I get tripped up over time, is just keep it simple, right? But it's wonderful. And that's why I think, obviously I'm biased here, but I think everybody should study Berkshire Hathaway. I don't think it will ever be irrelevant to business and investing. Certainly not in my lifetime.
And you mentioned the Warren Buffett Way as one great book on the subject. I see a lot of books behind you. Do you have any other recommendations for books for our listeners, not only Berkshire related?
Oh, sure. So I'm very much of the Charlie Munger mind. I really like Poor Charlie's Almanac and getting this worldly wisdom and thinking through, business economics through the lens of ecosystems in nature. I mean, it's so resonant. It just resonates with how the world works. So I think latching on to Charlie Munger will take you down a wonderful rabbit hole. And if you buy Poor Charlie's Almanac, he has dozens of book recommendations in that, which I've gone out and read pretty much all of them. Gosh, put me on the spot here. I really like Peter Bevelin's Seeking Wisdom, from Darwin to Munger. Business biographies are good too. I just finished Walter Isaacson's Leonardo da Vinci. Again, just kind of exposing yourself to some different thoughts, different ideas, sort of being a polymath. And I think Buffett likes to say that he's all business all the time, and Munger's the sort of worldly wise one. But when you, I mean, how many times have you heard Buffett? He quotes Bertrand Russell or some other philosopher or something. He understands a lot more of, this sort of basic elementary worldly wisdom than I think he lets on. And the more that you can go down that path, think through first principles, read a lot of history. I think history is another one that, again, it's not, we might get a different angle from a current writing of it, but generally it doesn't change. You can learn these lessons, timeless lessons. Manias, Panics, and Crashes, that's another one that just came to mind. Kindleberger, very good book. That's a good, just prompted a thought. If you go to brkbook.com, which is a shortcut to the Oracle's Classroom, I do have a book recommendations page. So I'll use that as my cop out for my book recommendations.
Perfect. We'll put that in the show notes. And how old are you now, if I may ask?
Sure. I'm 36.
It seems like you have done so much over such a short time, and hopefully you will have many, many more decades to learn and grow and develop as an investor and a person. So what are your ambitions if you're 92, like Buffett? Where would you like to be? Those easy questions.
Well, certainly living that long would be wonderful. And I really think his advice, his thinking of, when you get to be that old, you really want to have the people around you love you, and it's not all about the money. And I really think it's an overarching lesson to take away. And again, I think so many people should study Buffett just for the life lessons. There's so much more there. My ambitions, I work best alone. I'm not trying to grow Mead Capital to some $1 billion business or something. I'm really trying to be the best investor for myself and my clients. And so I want to have enough money to live on, have a long runway of above average compounding ahead of inflation. But I'm trying to find that. I'm trying to be the best version of myself, the best investor. And I'm not willing to trade higher personal earnings, just to go out and sell myself. Oh, I can generate this and get all these assets under management and have this huge business. That's not really what I'm trying to do. I want to enjoy what I do good for the people that I have that have trusted me to manage their capital. And as being 36, if I have 40, 50 years maybe runway ahead of me, starting small, at some point size becomes an acre, and I think that's it.
With your broccoli, I hope you will have a long runway to go. So lastly, where can our audience follow you if they want to invest or learn about everything that you do?
I mentioned brkbook.com, which is the Oracle's classroom. That'll redirect you there. I've kind of slimmed down. I tried to do all these social media things and it just became too much. So I pretty much hang out on Twitter. My handle there is BRK_student. Watchlistinvesting.com is both linked to the deep dives that I do, the paid version, as well as a free Substack that I put out from time to time. And if listeners are interested, just for this show here, I'm willing to offer 10% off your first year of Watchlist Investing deep dives with the code REDEYE, RADEYE.
Perfect. Adam Mead, thank you so much for taking the time to come on Investing by the Books podcast to talk about you and your great book, The Complete Financial History of Berkshire Hathaway.
You're very welcome. This is a lot of fun.
Thank you so much. Thank you for listening to Investing by the Books, a podcast by Redeye. Follow us on Twitter at IB_Redeye and email us at ib.podcast@redeye.se. To improve, we'd love to hear your feedback, so please rate and review us. Notice that the content in this podcast is not and shall not be construed as investment advice. This information is meant to be informative and for general purposes only. For full disclaimer, visit redeye.se. I'm your host, Eddie Palmian, and until next time, I sincerely wish you the best of luck on your journey through life and investing.